Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I discuss low volatility stocks and investing. In the first part of the discussion, we chat about how you can measure a stock's volatility, to why investing in low vol stocks works over time, to the types of stocks and sectors that show up the most in low volatility portfolios. In the second half of the podcast, we talk about one of the models on Validea, based on the research of Pim van Vliet, that blends low volatility investing with other simple and straightforward measures to find conservative stocks that have the potential to outperform the market when held in the model portfolio. As always, thank you for listening. We hope you enjoy this discussion on low volatility investing. Okay, today we're going to talk about a type of investing strategy, and probably a strategy, or I guess a type of stock that a lot of investors, particularly retired investors and retirees, probably have a lot of exposure to these types of stocks. And that's stocks that basically would be considered low volatility, or also known as low vol stocks. And what we want to do today is get into sort of the basics around low volatility, which we'll discuss in a minute. And then we're going to talk about one of the strategies on Validea that tries to capture this concept of low volatility in a relatively straightforward and simple strategy that has been tested over a long period of time. But to start, Jack, I thought maybe what we could do is let's just kind of ease into low volatility and talk about what metrics an investor might look at to try to identify low volatility type stocks.
Yeah, and to start, low volatility is one of the harder factors for those of us that follow factors to understand, because it seems to, the way finance works seems to, it seems to reverse it. Effectively, you're buying stocks that are less volatile than the market, and you're either getting the same return as the market or you're getting a greater return. And, so we'll talk a little bit later about why it is that low volatility works, but low volatility can be tough to understand for investors. But in terms of the basics of low volatility, there's really two metrics I think, are most widely used. One is standard deviation, which, we don't have to get into the detailed calculation, but standard deviation is just how volatile an individual stock is. So it's just looking at the stock itself. The least volatile stocks have the lowest standard deviation. And then there's beta, and beta sort of looks at the amount of risk a stock would bring to an already diversified portfolio. So it brings in the concept of covariance. So the concept of how the stock moves in relation to the market. So standard deviation sort of sits on its own. Beta brings it into this idea of covariance with the market into the equation.
And just to talk about standard deviation for the minute, I think over the long run, the market has a standard deviation of about 15%. So that means that most of the time, roughly 70% of the time, if the market's return over the very long term is 10%, you're going to be within a range of negative 5% per year to plus 25% per year. That's where most of the market's returns sort of would be, around that mean. So when we talk about standard deviation, that's just kind of the concept in terms of thinking of market-like returns. Did you want to talk at all about the low vol versus minimum volatility, the difference between those two things? Because I think we see those a lot, and sometimes investors might kind of get confused and think they're the same thing.
Yeah, it's important to talk about them because you see ETFs out there that use both approaches. You'll see low volatility ETFs and you'll see min vol ETFs. And so it's just important to understand you're getting a very different product with those two. So low volatility ETFs are using what we talked about before, which is they're taking the least volatile stocks and they're putting them into the product. Minimum volatility is more about building the least volatile portfolio, not using the least volatile stocks. And so when you want to build the least volatile portfolio, you actually can put stocks that are more volatile in there, because what you care about is the combination, the portfolios that's created by everything you put together. So they're trying to accomplish something maybe similar, but they're doing it in very different ways. So when you see a low volatility ETF versus a minimum volatility ETF, it's important to understand the difference between the two.
That's a good point. I didn't even really know the difference there, so I'm glad that you kind of pointed that out. In terms of, we talk a lot about the reasons why these factors work. When we think about value investing, at least systematic value investing, we can point to a risk-based explanation and also a mispricing-based or maybe behavioral-based explanation. With low volatility, like you pointed out, it kind of turns the whole, getting more return for higher risk sort of upside down. So there really is no risk-based explanation I don't think that I can think of, unless I'm missing something, but there is a mispricing one. And what maybe you can kind of just talk to what the idea around the mispricing or behavioral-based one is as why low volatility actually does well.
Yeah, so like you said, the risk-based explanation is tough. You know, if you're using volatility as a measure of risk and you're investing in low volatility stocks, then how are you going to make an argument that you're taking more risk and you're getting a greater return? The one thing I would say around the risk idea is that minimum volatility is not risk-free. And so what we're going through right now is an example of that. I mean, minimum volatility or low volatility, had a very long period where it outperformed, and now it's going through a very long period where it's underperformed. So just like the other factors, that risk of I'm going to have these extended periods where I underperform exists with low volatility, just like it exists with everything else. So although the risk-based argument from an academic standpoint is not really there certainly is risk in these types of stocks. But in terms of the mispricing, I mean, the best arguments I've seen are, one is your average investor can't use leverage. And so in order to juice up the returns of their portfolio, what they'll do is they'll buy these high beta stocks, and the high beta stocks will become overpriced. And so the low volatility stocks become less attractive or become more attractive relative to the high volatility stocks. That's one example. Or also investors have this tendency to chase lottery stocks, which is sort of the same concept. You know, these stocks that can produce huge returns. And so they overprice those stocks relative to these more safe, stable companies. So those are the two best arguments I've seen from a mispricing standpoint. But like you said, from the risk-based standpoint, you really can't. There's really not a strong argument in favor of low volatility.
When you look at like these low volatility portfolios, what you'll see is they kind of tend to cluster certain sectors or types of stocks, tend to cluster in these strategies. So for instance, in low vol, there's a lot of consumer staple type stocks or utility type stocks. And one of the things that O'Shaughnessy Asset Management pointed out a few years ago is at the time that they had run this study, which maybe it's changed now, but is consumer staples was actually the best performing industry over, I don't know how far they went back. It might have been to the 50s. It may have even been longer than that. And that sector was the best performing sector. And, they were sort of like asking the reasons why that might be. Some of those consumer staple stocks have, higher than average return on equity. And so, maybe over time that helped explain some of the outperformance as in terms of that being one of the best performing sectors. But when you kind of think about low volatility and maybe why it works, it may be partly driven by this sort of sector exposure or concentration in consumer staple like stocks, which over the very long term have tended to do very well.
And that also gets an important behavioral point, because if you contrast it with something like value, when you look at your portfolio and you're running a low volatility strategy, you're probably going to be fairly happy with the names you see. You're going to see good quality companies in there. Whereas when you run a value portfolio, you're going to see retailers in the mall, and you're going to ask yourself, why do I possibly own these things? So from a behavioral standpoint, it could be easier to stick. Not only is a low volatility strategy less volatile, but also when you look at your portfolio, you're going to feel a little more comfortable. So that can be an advantage for the factor relative to something like value, where you're seeing more, low quality companies in your portfolio.
Yeah, one of the things that you pointed out actually in your article, which was really interesting, this was using some of our own proprietary data, is how, and I'll let you speak to this, but the sectors and the exposure to low volatility as to where we are today versus where we are a year ago, you didn't see much movement from a sector standpoint, but within the factors you did. So maybe just explain that a little bit more. Yeah,
I wrote an article a while back about momentum where I stole a concept from Corey Hosteen, where I basically said momentum is a chameleon, which means momentum can be whatever's going up. So it can change from a sector standpoint, it can change from a factor standpoint. Well, in this article, I said low volatility is a chameleon, sort of. And the reason is low volatility can also change. It's not tied to fundamentals like something like value. It can, whatever stocks in the market have the least volatility is where low volatility is going to go. But low volatility changes a lot less than momentum. And so that's why I was saying, it was sort of couching it with the sort of in the heading, because if you look at the sector exposure of low volatility at the market bottom on 3/26/2020, and you compare it to the sector exposure of low volatility now, it almost hasn't changed at all. I mean, the biggest sector overweights were 14% overweight utilities then, 13% overweight utilities now. 10% overweight consumer staples then, 10% consumer staples overweight now. So that really hasn't changed a lot, but where it has changed is when you look into the factors. And so low volatility was coming off a good run, sort of when we had the market bottom. And so low volatility did not have a lot of value tied to it. The stocks were more expensive than they normally are. But it did have a lot of momentum. The stocks had a pretty good run. So at the market bottom, low volatility, using our factor scores, which are 0 or 1 to 100, with 100 being the most exposure to the factor, At the bottom, low volatility had a 44 exposure to value, but now it has a 61. So low volatility has struggled in this market rebound, and it's actually become a lot cheaper. So it makes the factor look a lot more attractive. Whereas from a momentum perspective, it had a 66 momentum at the bottom, but now it has 24. So its momentum has plummeted. As you know, these lower quality value stocks have led the rebound. These sort of low volatility, more recognizable name companies have struggled relative to them. And so you haven't seen much change in the sector exposure, but you've seen a lot of change in the factor exposure.
Yeah, that's a good point. On Validea, we call it the multi-factor strategy, but it's really a strategy that seeks to identify lower volatility stocks and more conservative stocks. And the strategy is based on research by a professional investor, Pim van Vliet. He wrote a book. The title of the book is High Returns from Low Risk, a Remarkable Stock Market Paradox, and also a research paper, The Conservative Formula, Quantitative Investing Made Easy. And let's kind of step into the strategy in a second here. But before we do, one of the things he tested, this strategy that we're going to explain, he tested it from 1929 to 2016, and a 100 stock portfolio of the most conservative stocks rebalanced annually, I believe, produced a simulated return of 15.1% per year versus 9.3% for the market. So the criteria that we'll explain in a minute, that went into selecting the 100 stocks that scored highest, and that, at least on a back-tested basis, delivered some pretty impressive outperformance over the market. And there's some other characteristics we'll talk about in a second too. But Jack, maybe if you want to kind of get into, let's step into some of these criteria and we can talk about them here.
Yeah, just to take a step back, one of the things for people like me who are maybe less comfortable with low volatility because we can't explain it as well as we can explain the other factors, you really don't have to use low volatility on its own. And so low volatility works very, very well with the other factors. I cited a paper in my article that showed that when you combined low volatility with value, you got a 2.2% excess return per year. So you can combine low volatility with things like value and momentum, and you don't have to use it on its own. So if you want to get the benefits of low volatility, but you're maybe not comfortable with the factor on its own, that's a good way to sort of handle that. And that's what this formula we use on Validea gets at. It doesn't use value, but it does use some other criteria to say, all right, we're going to look for stocks that are less volatile in the market, but we're going to couple that with some other things that we also think generate an excess return over time to build a portfolio. So just going through the individual criteria, it starts with the market cap, and it wants stocks that are within the top 1,000 stocks in the market. And those tend to be more stable companies when you get into the small and micro cap arenas. And then it tries to, using 3-year standard deviation, it basically cuts the market in half. So the stocks that are in the bottom 50% in terms of their 3-year standard deviation, those are the ones that can be included in the portfolio. So that's the low volatility component, is we start with this universe of big stocks that are less volatile in the market, and then we run some additional criteria to rank them. And so what we use is momentum, which works very well with low volatility. We rank the stocks based on 12-1 momentum, which is just momentum in the past year, excluding the most recent month. And then you rank them again based on net payout yield, which is effectively dividend plus share buybacks. And then you combine those two rankings into a final ranking. So you're starting with this universe of stocks that are in the bottom 50% of the market in terms of volatility, and then you're ranking on momentum and net payout yield, and then you're building a portfolio with the best combined ranking. So you're getting elements of these other factors in addition to your low volatility.
Notice that there are no accounting metrics or variables in this strategy. It's a really simple, straightforward investment strategy, and that's actually intentional because as Van Vliet points out in the paper, he wanted to make this a very easy formula that could actually be followed and implemented. And everything you're seeing here is a pretty straightforward in terms of it's not looking at anything on the balance sheet, anything on the income statement. It's just, like you said, market cap, standard deviation, and then it's ranking by the net payout yield and momentum.
That's right. Yeah, that's a really good point, because complexity can be the enemy of following an investment strategy. You want to be able to, as an investor following an investment strategy, you want to be able to explain to someone fairly simply, why am I following this investment strategy? And this, as you pointed out, this strategy is very simple to explain. I'm buying stocks that are less volatile in the market, that have momentum, that have high payout yields. That's basically the entire strategy. I can explain it. Whereas some of our other ones, you have to go into a lot more depth to try to explain why you're following, why you own the stocks you own.
One of the things in the back test. So it does go back to the 1930s, basically, that Van Vliet tested it back to, as we said, 1929, I think. But he shows this strategy's performance every decade going back to that point. And what the back tested performance shows is that it never had a losing decade, even in the 30s. And that's very important because, as he sort of pointed out, investors, have relatively short time horizons. So the fact that this strategy has never had a losing decade, where you would have had 3 losing decades, if you just would have bought the market, you would have had really 2 losing decades over that period of time, the 30s and the 2000s. If you would have bought speculative stocks, which he also shows in here, you would have had 3 losing decades: the 30s, the 70s, and the 2000s. I guess the market was basically flat in the 1930s, when it kind of came all the way back by the end of the 30s, according to the data I'm looking at here. So that's an interesting and important thing for investors to consider if they're learning about a strategy like this.
Yeah, and you contrast that with something like value. I mean, value, you have these really, really long periods where you lose. So yeah, this seems like it would certainly be an easier strategy to stick with. You can argue whether value performs better, and in the testing, value probably does perform better than low volatility, but low volatility is going to be much easier to stick with than value, as all of us know who went through that past decade in value where it really struggled.
Yeah, and that's another point that he made in the paper, is that per unit of risk, this conservative formula that he built, it does really reward investors actually more than the pure factors and even, I think, the Fama French sort of stuff. So, you're really getting solid returns and you're doing it more conservatively. And so, it's an appealing strategy, I think, for a lot of investors.
Yeah, but like we talked about earlier, the one thing to keep in mind with any factor strategy is you're going to have these periods where you struggle relative to the market. And, we're in one of those right now for low volatility. They're not as bad with low volatility as they are with value, but they certainly exist. And, you have to understand, whenever you're doing anything that makes you different than the market, the price you're going to pay is these periods where you trail the market. Yep.
So we'll put a link to a lot of stuff in this. Maybe I'll even pull that chart in that we talked about. I can drop that in. And then, we hope this was a good, interesting discussion on low volatility and a strategy that tries to harvest this along with other variables. And we will see you next time.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.